So the autumn statement took place in Parliament today, and this is where the Chancellor outlines some of the kind of short-term plans for the economy here in the UK. It's kind of like the budget. The budget which takes place in March is kind of like a mini budget of some sorts, more kind of big economic things which we won't talk about right now, but still some policy decisions. And with a general election likely to happen at some point in the next year, obviously a lot of people are thinking, will the Conservatives use this as a kind of a ploy, or even just a way to try and get in some goodwill and maybe some votes when that comes around? And there was a lot of talk about tax cuts and everything being on the table. There was also a lot of speculation about what might happen with ISAs and could there be some changes going on. So in this video, I'm going to take you through those headline changes that have come along and how they will impact your money. And let's start with tax and personal tax, income tax. What's going to happen to our kind of the tax that we pay when we earn money? There were no changes to the income tax bands that we have. So when we pay, the bulk of our tax is in income tax. There were no changes to this. And in fact, they have been frozen. They've been frozen for a while now, and they are going to remain frozen until 2028. That has not changed at all. What they've done instead, what the Jeremy Hunt, the Chancellor, did instead, is announce a handful of changes to national insurance, which effectively is a tax, right? We might not call it a tax, but it is money that comes out of our pay and goes towards paying for different services. And although it isn't explicitly and exclusively about paying for the state pension, it is something that's very important. And I'll come back to this in a moment. Very important that we do pay national insurance, because it's those national insurance qualifying years which will mean we're eligible for the state pension or signify how much of that state pension we'll get when we retire. So the changes have happened here. A few of them are for the self-employed. We'll come back to the first ones are the biggest ones. This is the big, I call it a rabbit out of the hat, kind of like a ta-da right at the end, right? This is kind of the big thing which potentially might make people think it's good for them and good for their pockets, was a reduction in the national insurance, the employee national insurance rate. Now, this one will be cut by 2%. Currently at 12% of earnings between 12,570 and 50,270. So earnings in that bracket, you don't pay it before that. And after that, you pay a 2% rate, which isn't going. So just in that rate, currently 12%, it will drop to 10%. Now, this is normally these kind of changes come into effect for the start of the financial year. So April 2024. This is coming in on January the 6th, 2024. So what's that? 6 weeks time? So a lot sooner. So it does mean when you get paid at the end of January, you will have more money that you can take home. You would have paid less. So how much is that going to be? Well, it obviously depends how much you earn. The headline figure that they gave, the Chancellor gave in Parliament, was if you want an average salary of £35,400 a year, you would save 450 quid every single year. Technically, these amounts that you're saving are based on a financial year. So from April through to April, but it's going to be April because it's the 6th of January. It's not a whole month. It's a bit messy there, but let's think about it in a financial year, 450 quid a year for this typical earner. Now, I've got some other examples here. So if you earn more than that, if you earn £38,900, your annual gain will be 520 quid. If you earn £44,300, then you'll get 630 quid back, or pay £630 less every year. If you are 63,000 pounds, then it will be over 750 quid that you will get each year. So this is good news, right? You will have more money to spend from January onwards. What's really important here, that is vital here, I said there were no changes to the income tax bands. They have remained frozen. They will remain frozen, as I say, for another, 2028 is what we're saying. So another sort of 4.5 years at least. That means that if you get a wage increase, a pay rise, and you earn more money, and that pushes you into a higher tax band, you're still going to be paying those higher rates of tax on those earnings within those tax bands. And this is what's known as fiscal drag. But it's kind of been a buzzword for the last few weeks in terms of personal finance, newspapers and things. But fiscal drag is a very, very real thing. And more of us all the time will be pulled into these higher rates of tax on some of our earnings. Obviously, there are knock-on effects of that. If you go up, your personal savings allowance will reduce if you go from a basic rate to a higher rate and so on. That is still going to happen. And the amount of money that's forecast for that to bring in over until 2029 would be around £45 billion. Whereas the amount that this particular national insurance contribution cut is going to give us back collectively in that time is 10 billion. So yes, we're getting a tax cut, we are getting more money back, but overall we are paying more as well. So it's kind of like take with one hand, give with another, but we're still going to be better off if the national insurance, if the income tax thresholds had been increasing in line with things like inflation. So that's the first one. That's going to affect people who are workers, your PAYE. There are also changes, as I said, to self-employed national insurance. There were two levels of this. First of all is Class 2 national insurance. Now, this is something that you pay if you are self-employed and you earn more than £6,725 a year, then you will pay a set amount of £3.45 a week in national insurance contributions. Again, really important that we make these. As I say, you pay these because this is what ultimately will qualify for you for certain benefits, but also that state pension later on. So this is a cost that self-employed people are paying above that limit. Set amount. Doesn't matter how much you earn above that, you pay this amount. This has been scrapped. It will be scrapped from April 6, 2024. It will be gone completely. Now, this is a technical, important thing here. Why I keep talking about this sort of state pension thing and other kind of entitlement to benefits. This will not be impacted. You will still get those qualifying years towards those kind of benefits, state pension in particular, as long as you earn more than that threshold, that £6,725 a year. This is profits, by the way, not earnings. So self-employed, your profits above this that you declare, then you will continue to get that. However, we don't have to do anything at all, right? You'll get it. However, if you earn less than this or your profits are less than this, at the moment, you don't get those qualifying years. And the way that you would have to generate those is to make a voluntary contribution. So you would physically say, I'm going to pay this money just so I can ensure I do get a certain level of state pension or other things later on. That won't change. You're still, if you want to be doing that, you will still have to make those voluntary contributions. The rate at which you will make them will not change though. So currently it is £3.45 a week. It was due to go up to £3.70 a week. It will stay at £3.45 from April onwards if you want to make those voluntary contributions because you earn less than that threshold, which is currently still set to stay at £6,725 a year. And this was a little bit cheeky, actually, because when the Chancellor says how much this measure is going to save people, they talk about it being worth £192 a year. That's based on the new rate that was due to come in April, that higher £3.70. If it's actually just remaining at £3.45 for people who do need to make the voluntary contributions, then really, and what it is right now, is a saving of £179.40. I know we're kind of splitting hairs here, but I thought it was a cheeky little thing and say, look, it's going to be worth this much money to you, but well, you're not paying that amount right now, and you're never going to because it's not going up, so at least not in the next year. That's the first thing for self-employed. The other thing for self-employed people is for those who have profits of above £12,570 up to £50,270. You'll recognise those figures. They are the same ones we've got for the basic rate taxpayer and the higher rate taxpayers, but obviously slightly different if you're self-employed with profits. That rate, above that rate, at the moment you pay 9% tax on the earnings within that threshold. That will drop down from April to 8%. And that is going to be worth around 160 quid a year on average. Obviously, it does depend on whether your profits are towards the lower end or the higher end. But combined, that's going to be about, 350 quid for the self-employed. People will be better off on average from that. That is the main thing around tax on earnings. There's one more thing to talk about with earnings. We'll jump to that now, and I'll come back to some of the other things in a minute. This is a good one if you are on the minimum wage, because the minimum wage, or the living wage as they call it, though it's not anywhere near to the actual what's a true living wage. But that is going to increase. The living wage is going to increase from April. It is currently at £10.42 an hour. It's going to go up to £11.44 an hour. So give you an indication of how different that is to what the actual, the proper living wage campaign is set out is. That'd actually be £12 an hour outside London and £13.15 inside London. So a big increase, a large increase, but still lower than what these groups, campaigning groups, believe you actually need to get by. But still nice to see, very welcome to see this increase. That's going to be worth around £1,800 a year if you work full time. However, there's another change here which is really interesting. And at the moment, that national living wage kicks in at the age of 23. That is going to change from April down to 21 years old. So if you are 21, 22 right now, you're going to get an even larger increase from what you get right now up to that £11.44 an hour. And that would be worth an extra £2,300 a year. So £500 more than someone who's 23 or above. There will also be an increase if you are between 18 and 20. The hourly rate there will change from £7.49 to £8.60. So that's earnings. What else to talk about here? While we're here, let's talk about pensions as well. The state pension is going to increase by the triple lock. The triple lock is a mechanism which kind of decides the highest of these three different measures. That is what the state pension will increase by every single year. That's the rule. It was obviously paused during the pandemic, and there's speculation about whether this is sustainable, whether it's going to carry on or not. This time it is going up by the highest figure, which is earnings. That is a rate of 8.5%. So average earnings in April, that's how much the state pension will increase by. So it will be £221 a week. There was, as I say, speculation it might instead go up with September's inflation figure, which would have been 6.9%. But it's gone for the higher figure, at least for another year. Worth about £900 a year for people on the state pension. Pensions, and one extra thing here, don't really know much about this, but the Chancellor said that they are going to be reviewing workplace pensions, and one of the things that he wants to have available to people is they say that when you join an employer, you can say, I want you to pay into this pension that I've already got, including their contributions and all this kind of stuff. The idea being eventually, you've got a single pension, which is much easier to manage. Obviously there are going to be lots of complications with that. We still don't have a pensions dashboard, which has just been, when I was at the Money Advice Service running their website, God, what was that, 2014 I joined there? There was talk about all that stuff going on. Still hasn't come to fruition. The idea that we can see all your pensions in one place. So, getting there, and it can make sense, I'm sure, in lots of ways. But obviously, if you don't want to do that, there'll still be the ability, I'm sure, for you to have, almost absolutely to have lots of different pensions. But people who do want one pension, and they can just go into it and it's all there, keep things relatively simple, that is on the cards. While we're talking about income, let's talk about benefits as well. The benefits, universal credit, things like that, disability benefits, they are going to increase by September's inflation rate of 6.7%. There was, again, speculation that they actually might go with October's rate, which, as I told you about recently, was 4.6%. So that's good news. The benefits are going to go up by that slightly higher rate. Potentially, that's going to be worth around £470 a year for those on those qualifying benefits. Another kind of change is around something called the local housing allowance, and this is what's used to kind of work out the housing benefit or the housing element of universal credit, how much you will receive. Now, this has been frozen since 2020, but obviously the rents have been, as you know, if you're a renter, rents have been going higher and higher and higher and higher. And that's meant while this allowance of what qualifies has been here and the rents have been going up like this, so many more people have not been able to access the support they need to try and make housing affordable. It's been a huge problem over recent years. Well, what's happening is that allowance is going to increase, so it covers basically a third of renters. So more people will be able to access support in order to help them make these rents manageable. So that is good news that's going to come into play. And before we get on to some other tax things, other savings things, I do want to quickly sort of also share with some announcements, which is quite strict. And this is around benefits again. And this is some new measures that are about trying to push people back to work. The whole thing they're talking about, the way those tax changes earlier on was about tax benefits for workers, not for all sorts of income. You have to be working to benefit from that national insurance change. They really, really want to push more and more people back into employment. I guess the Conservatives will argue then that is good for the economy and also reduces that the benefits, the welfare state bill for that. However, it sounds incredibly harsh. I'm sure there will be lots of backlash on this, but there will be new measures that if you haven't found a job, if a job seeker has not found a job after 18 months, they'll be required to attend some work placements for around 6 months. And if that doesn't work, they refuse to do that, then their benefits will be ended. So this is like, coming down quite hard on sanctions. And I guess the thing there will be, are there people taking advantage or are there people who genuinely can't work or can't get a job for whatever reason? So that's something there, a footnote to share with you on benefits as well. But let's go back to some of the more kind of tax things, and then we'll end up talking about savings. There's only a couple of tax things to talk about here. You might have been anticipating some news on stamp duty. Nothing. You might have been anticipating some news on inheritance tax, because that has been spoken about a lot. Nothing. Nothing on those big sort of taxation areas. And in fact, the only other kind of tax things that we heard about were tobacco tax, tobacco duty. That would increase from 6 p.m. today, the 23rd of November. So if you're a smoker, it's going to cost you the RPI rate of inflation plus 2%. So that's going to cost you more money from today. Whereas the alcohol tax, that would normally also have gone up, and it generally tends to be the case, that has been frozen. So alcohol duty will not be going up as originally planned. Okay, now let's talk about savings. I know so many of you watch the channel. This is going to be a big thing for you. What's going on with savings? Have there been any changes to the personal savings allowance? Have there been any changes to the lifetime ISA? All these kind of things which, would be great news. So many people now have been paying, or will be paying tax on their interest thanks to those increased savings rates, thanks to the increased interest rates over the last 2 years. But that obviously the downside of getting more money is you're going to have to pay the tax on it. There have been some changes to ISAs, but sadly none of them in terms of allowances, either ISA allowance remaining at £20,000 and can collectively for a financial year, and also that personal savings allowance, £1,000 for a basic rate taxpayer, £500 for a high rate taxpayer, £0 for an additional rate taxpayer. They have not changed at all. Nothing is going on there. What has changed in the world of ISAs are pretty much kind of more admin based things. And I think these are good things. So this will come in from April next year. It's partly why I've held off doing a few more ISA videos recently. I've got a few more to share with you, but I'm like, let's just see what happens. But this is around, the first one is around the number of ISAs you can have in, or you can pay into in a financial year. At the moment, you can only pay into one of each type. So you can pay into one cash ISA, one stocks and shares ISA, one lifetime ISA, one innovative finance ISA if you really want to. That's it. You can have ones from previous years, from different ones, and then a new financial year comes in, you can pay into a new one, but you cannot pay into more than one in a year. And that can be, one, confusing, but also frustrating. So you might have put money into a fix at the start of the year. Your money is locked away. You can't add any more money to that, but then maybe more money's come along. You've got a pay rise, you've got a bonus, whatever it might be. On the rates, I'll put some into an easy access, or maybe a different length fix. At the beginning of the year, you want some in a 3, some in a 4 year. You can't do that. One ISA for the year that you can pay into. That will change. You will be able to pay into multiple cash ISAs, multiple stocks and shares ISAs, presumably multiple lifetime ISAs as well, and multiple innovative finance ISAs within a financial year. So that is good news. That's going to come in from April. What else is going to happen? Partial transfers between providers. That is going to be allowed. At the moment, when you do a transfer from one ISA to another, really important you do this rather than withdraw the cash and pay it back in, because you want to protect that ISA allowance each year, particularly if you have larger sums in them. Generally, a lot of these places, when you do the transfer over, you transfer the whole lot. You can't just transfer some of it. They are going to allow partial transfers, which is good news. Possibly bad news, not going to affect many people here, but they are going to normalise the age in which you can open up an ISA to 18 years old. Obviously, forget about the junior ISA. That's for kids, right? That's going to stay as it is. But there are some cash ISA accounts which are available to people aged 16 or 17. That will go. That will be pushed up, so it'll be 18 across the board. I think it's very unlikely, but if you are a 16 or 17-year-old, or you've got a kid who's 16 or 17-year-old and they have enough money they want to be taking advantage of the ISA allowances now, well, then you've got until April probably to do this. Although, realistically, I don't think it's going to be that important for most people, but that will be happening also from April. And although I don't cover investing on this channel, there has been a lot of noise. I've seen some of my friends who also have channels here talk about fractional shares within ISAs, and massive hits, massive views with people worried about what that means for them. Well, there's been some clarity come through on this. Not perfect clarity, but some clarity on this. For those of you who don't know what a fractional share is, this is basically where you buy part of a share. Because some shares are very, very, very expensive. So you couldn't buy a whole one, but you could buy a part of it, and that means you can benefit if that company was to grow, and you can get past that without having to own a whole thing and put loads of cash into having it. and lots of people. It's very popular with some of the sort of newer investing apps over the last few years. There was a sort of stuff a few months ago which kind of came out and said that they aren't covered. You're not allowed to have a fractional share within an ISA. And the reason for that you weren't allowed it is because they didn't exist when the ISA rules were all put together. So you weren't allowed to have it. So what they've said, and this, by the way, all this ISA stuff wasn't in the announcement in Parliament. You have to dig down into the documentation that's released afterwards, this green book, and it's in there. It says they are going to be consulting on this, but it looks like that will be okay. They basically update the rules, update the frameworks, so you will be able to have these fractional shares within an ISA. Now, again, we don't know when this will come into play. I would imagine it's not going to be for April 2024, because they've got to get the stuff out there, get the stuff back, and then get the rules in place. So you're looking more likely to be maybe a year after that. But I can't imagine that now they're saying they want to do this, that there will be any action taken by any ISA providers or by HMRC to try and punish people for that and try and say they want to get you to pay tax on those kind of things. So that's good news for those of you who are have ISAs. And there is one more thing to say on ISAs, and then one more thing to talk about with savings as well. One thing that hasn't sadly had any change happen to is the lifetime ISA. I've got a whole video about those. If you don't know how they work, you can watch that. But fundamentally, a lot of the campaigning that's been going on, I get press releases all the time from all sorts of people about this. And rightly so, I agree with them. Were two changes they wanted with lifetime ISAs. One was to increase the threshold in which you were able to use this for your first home, because that's set at £450,000. And it has stayed at that price since they were launched, which it's over the whole of the UK, and you might be fine in some parts. But if you're London and the South East, that could rule you out. And if your property is higher than that, then you can't use the money in your lifetime ISA until you are 60 years old. And that could be, 30 years, 40, well, probably not 40 years, but do you know what I mean? That could be a long time before you can access that cash. Unless, and this is what brings you on to the other thing that people were asking for, that you pay a penalty, a 25% penalty. So you remember, lifetime ISA, you get 25% bonus, but then you take 25% off that. It doesn't just wipe out the bonus, it takes about 6.7% off your initial deposit. So you will lose money to take the money out early. And the request was for that to be changed as well. Sadly, neither of those have happened. It seems ridiculous, particularly when it comes to changing the property threshold on lifetime ISA, why you don't change that. It doesn't seem that hard, but again, nothing has changed there. Now, the last thing to tell you about, and very briefly on this one, is potential changes coming to the Help to Save scheme. Again, this was not announced. It was just a couple of lines within the big sort of 100-odd page document that they are going to be reforming, I think actually is the word they use, the Help to Save scheme. Now, this is a really good scheme right now where for low earners, if you're eligible for it, you can put in money into a savings account. You can access it if you wish and then put money back in. And obviously only certain limits. It's quite a small amount you can save overall, but they give you a 50% bonus, which is amazing. The idea is to get people having some kind of savings buffer available to them. Really good. That is going to change. More details will be announced. And when they do, I'll tell you about it. If it's really substantial, really big, I might do a separate video, but I'll certainly be telling you about it in my monthly savings update videos, which I share here, normally at the start of every month. Go through the best paying savings accounts, any other news that's come along. So make sure you do listen out for that. Again, this is everything so far. I'm recording this just shortly after the announcement has happened. If more things do come along, I have got an article at becleveryourcash.com where I add stuff in there, but I think that's pretty much covered where we are on the information we have so far. Thank you so much for watching. Make sure you check out these videos here for more ways to get the most from your savings.